Welcome to this video on Trading 212's Cash ISA that provides a way to invest your money safely while earning competitive interest rates on Trading 212. And we'll also compare that with Trading 212's Stocks and Shares ISA. Please remember that nothing in this video should be construed as financial advice, and you should always do your own research before investing. So what is a Cash ISA? A cash individual savings account, or ISA, is a savings account available only in the UK where any interest earned is tax-free, meaning you don't pay income tax on that interest and you don't need to declare the account on your tax return. There are limits on how much you can put into your ISA in one tax year, and the limit as I make this video is £20,000. If you don't use that allowance, you lose it and you can't carry it forward to a future year. A cash ISA also allows you to access your money at any time. Now, as their name suggests, cash ISAs are for saving cash, but there are also other types of ISA available. For example, in the UK, we've got stocks and shares ISAs, innovative finance ISAs, and also lifetime ISAs, and these offer you a wider range of investments than a cash ISA. How about a stocks and shares ISA? The first point is that while cash ISAs are limited to cash, with a stocks and shares ISA you can choose from thousands of single stocks or exchange traded funds in your Trading 212 stocks and shares ISA. Furthermore, over the long term, cash usually earns a low rate of return. The benefit of paying no capital gains tax is likely to be much greater over the long term for a stocks and shares ISA than a cash ISA due to the low long-term return for cash. Over the short term, however, you should be aware that stock investments have much higher risk and their prices can fluctuate much more than that of a cash ISA. Also, while a cash ISA comes with an FSCS guarantee up to a value of £85,000 per person per authorised institution, a stocks and shares ISA comes with an FSCS guarantee if the platform fails, but no guarantee for loss of value in the funds in the ISA itself. So what is a cash ISA useful for? Investing is generally a trade-off between risk and return. The lower the risk you take, the lower the long-term return you might expect. Cash ISAs are at the very safe end of the investment risk spectrum, and as such their returns tend to be lower than more risky investments such as bonds and stocks. For short periods of time, they offer a safe and steady rate of return. Over long periods of time, however, stocks tend to outperform lower risk investments like cash ISAs. But of course, this greater potential return comes with a greater risk of short-term price falls. But this is why if you have money to invest that you don't need for a decade or longer, investors usually opt for share investment rather than cash ISA investments. The return on a cash ISA varies over time, driven by UK short-term interest rates, and the rate that most short-term funds reference is called SONIA, or the Sterling Overnight Index Average Rate. Now you can see that shown here in yellow. In turn, that tracks the Bank of England's policy rate, which is called bank rate. And what's unusual as I make this video is that the SONIA rate is higher than the rate you get with UK government bonds. Here you can see the SONIA rate versus the rate on 5-year UK bonds, which is shown in blue. And as you can see, the SONIA rate is higher, but it's falling as the Bank of England cuts interest rates as it feels it's getting inflation under control. So bear in mind that eventually the rate of return on your cash ISA is going to fall, and it's almost certainly going to be lower than the return on, say, a short-term UK government bond. Why would you ever consider receiving a low rate of return on your investment? Well, if you need to withdraw and spend your money over a fairly short period of time, say you plan to buy a house in a few years, then investing in stocks is very risky. That's because over short periods of time, stocks are quite likely to lose value. A stock market crash could mean that you end up with a shortfall at precisely the time you need your deposit on your house. In contrast, if you put the money into a cash ISA, it earns a steady but small return and it's very unlikely to lose money, and that means you can plan for short-term expenses. Both Trading 212's cash and stocks and shares ISAs are flexible ISAs. But what does that mean? A flexible ISA means that you have the option of moving money into and out of your ISA over the course of the tax year. Now that's as long as your net proceeds don't exceed your ISA limit for that year. So for example, you could put in £20,000 at the beginning of the year, but later remove £10,000 to spend. And then if you have the funds, you could put that £10,000 back into your ISA. And for a flexible ISA, that won't exceed that year's ISA allowance. Compare that with a non-flexible ISA where any new money you put into the ISA counts towards that year's allowance, and you can see the benefit of this flexibility with Trading 212's ISAs. Trading 212's cash ISA pays interest frequently, but why does this matter? Compound interest, remember, is interest on interest, and that means that the more frequently you receive interest, the greater the amount of compounding you get. Trading 212's cash ISA pays monthly, and for a given rate of periodic interest, this increases the return you receive. For example, if you invest £10,000 at an annual rate of 5% and increase the frequency with which you receive interest, this increases your return over a year. The more frequent the interest payments, the greater the interest on interest. However, as we go from monthly to daily interest, the benefit starts to diminish. The rate of return on a cash ISA is variable, but what's it driven by? Short-term interest rates for UK investments are usually benchmarked against the sterling overnight index average rate that we saw previously, or SONIA as it's called. And SONIA is the rate at which banks can borrow and lend to one another. You can see here that SONIA, as it's called, tracks the Bank of England's policy rate or bank rate quite closely. This is usually the upper rate you can expect to earn from safe sources of income from things like a cash ISA. Now, some cash ISA managers will keep more of the interest for themselves and pay you less than others. However, Trading 212 offers one of the most competitive rates on its cash ISA. In summary, what are the pros and cons of Trading 212's cash ISA? Well, the pros are that cash ISAs offer a safe place to invest your money over the short term, and that's without crashing in value. They're simple, and in the case of Trading 212's cash ISA, it's flexible. That means you can withdraw and replace 1 year's ISA allowance over the course of one tax year. Now let's switch to the cons. The price you pay for safety is low return. Compared with inflation, the return on a money market fund will usually be quite small. Compared with a stock market investment, money market funds are likely to underperform over long periods of time. And compared with a diversified global stock investment, it's likely that that money market fund will underperform over very long periods of time, such as a decade, for example. And the final problem with cash ISAs is that the rate of return you receive is variable. Interest rates will fluctuate up and down. How about the benefits of a stocks and shares ISA? Comparing cash ISAs along stocks and shares ISAs, the most important difference is safety. While a cash ISA is focused on safety, a stocks and shares ISA is used for longer term investments that have the potential to generate a higher rate of return. That has an impact on volatility, such that cash ISAs are less crashy, while stocks and shares ISA tend to be more volatile. And then finally, cash ISAs are very simple, whereas a much wider selection of investments is available for stocks and shares ISAs. And that adds flexibility to a stocks and shares ISA at the cost of complexity. I hope that's helped you understand cash ISAs and how they can be used to generate a safe, tax-free rate of interest, but also how they compare with stocks and shares ISAs. Please do like this video if you found it useful, and don't forget to subscribe to Trading 212's channel so you don't miss any future videos.